Welcome back to On the Money, powered by Allied Wealth. I'm your co-host and host sometimes with a host, the most, Spike Spangle.
You're the man. You're the pilot. You're the
Gotta
pilot.
have some
You are the
fun.
main pilot. You are the chief
Well, I
pilot.
gotta have some fun with Spike over here, folks. The funny thing about Spike is a lot of people think that Spike's just my co-host in the show, but Spike's actually licensed as a financial advisor. Has been doing this a long time, and is a great colleague and friend. And it's a pleasure to work with him on the show. And then, we kind of do a lot of prep work, and Spike's got a couple of things here related to what I believe, and he sometimes disagrees with me, by the way.
Well, I always like to, I'm going to steal your phrase, and I don't mean this at you, the stump the chump. No, I don't mean that you are the chump, but the stump the chump. You said in our previous segment, for those who are listening on radio, and if you missed it on YouTube, you can go back, click on the previous video, about having $1 million or $3 million in retirement, whatever it is, divide that by your years. We're just doing real simple linear math. But what if that was all tax deferred? What if that was 401k, 403b, 457? What if we haven't paid taxes on that? I don't actually have $3 million divided by 30 years. I don't have $100,000 to spend. I have that divided by my tax bracket at the time when I pull it out. What about tax efficiency? What about getting tax efficient before we start taking money out? Because then we got that Social Security and the IRMA and RMDs and all that stuff. When do we start talking about taxes? Do we wait until our retirement years?
We start talking about taxes now, right now. And we don't wait for retirement years, all right? One of the biggest mistakes we see, Spike, is people save the money they're going to use to finance their lifestyle in retirement. They save 100% of it in two areas. One of them is a pension, all right, which is not a bad thing because that's how pensions work, okay? The other one is inside of a tax-infested retirement account. Now, why do I say tax-infested? Well, let's think about it. Spike, you've got $1 million in your 401k. How much of that $1 million is yours? I do this at the class. At every single class, we start talking about taxes and how taxable income is created in retirement and how to shield yourself from taxation. But the reality is, if you've got $1 million 401k and you take it all out, all right, at one time, now you wouldn't do that, obviously. Okay, but this shows the power of tax efficiency. You're going to pay at current tax rates, you're going to pay about 37% of that money is going to be lost to taxation. So $1 million minus 37% is $370,000 in taxes. All right, which means the amount of money inside of your 401k IRA at that tax rate is $630,000. Ain't $1 million, it's $630,000.
So am I doing the math completely wrong on my retirement? If I'm adding up what's in my 401k, do I need to have 20 or 30 or 40% more than what I'm looking at?
Well, let's look at it this way. Let's say that we can move you from that 37% bracket to the 12% income bracket. Okay. Well, now on $1 million 401k, $120,000 of it belongs to taxes, and the other $880 is actually yours to work with. Okay. Now, folks, listen. I know you're thinking, well, Ryan, the money in my 401k is mine. If I don't take it out, I don't pay tax on it, and you are right by that. Okay, but every dollar you put into that 401k, every dollar of match, every dollar of growth has never been taxed. And so Uncle Sam wants his money. And I do believe that's the adage of where the only two guarantees in life are death and taxes. I believe they came from the 401k, all right? Because every dollar you take out is 100% taxable. Now, this is where it gets really, really important to understand tax efficiency. Spike, does your money last longer if you're at a 12% effective tax rate or a 22% effective tax rate?
I'm going to assume 12.
That's right, because you've got more money in your pocket at the end of the day because you're paying 10% a year less in taxes. Actually, more than that. It's like 40% a year less in taxes. And so your dollars will go further. All right. So The bottom line is teaching folks about tax efficiency in retirement is so important. The challenge is that many people don't take it into account and they don't understand the tax ramifications of having all of your money saved inside of a tax infested retirement account. The best way to do it is to have an equal amount of money in an after tax account, a brokerage account, as to a 401k account, as to a Roth IRA. We call that composition of accounts. And I could have somebody with that type of composition of accounts with a very large amount of income in retirement and keep them in a 12% tax rate. Okay.
Wow.
But for someone who comes to me with all their money in a 401k that they're going to use to finance their retirement lifestyle, all right, that's creates a more challenging situation to help mitigate tax liability. Doesn't mean it can't be done, but it does mean some mindset shifts have to occur. For instance, had a guy come to us, doesn't like the government. He's kind of a conspiracy theorist guy, all right? And he's like, I don't want to pay any more taxes than I have to. What do I do? Okay, listen. The first thing we're going to do is you're not going to take your Social Security income until you're 70. No way. I'm getting every dollar out of my Social Security. I don't know how I'm going to live. I'm taking all the money now. I'm starting Social Security at 62, Ryan. Don't even try to convince me any differently. Okay? Exactly what the guy says. Mm-hmm. Like, sir, fair enough. However, if during this period of 59.5 to age 70, if I could do Roth IRA conversions at a lower tax rate, all right, and convert a lot of your IRA money over to Roth IRA money to where it's never taxed again, and the taxes you're paying on those distributions are lower than they will be later in life, I'm saving you a ton of money in taxes. But if we start taking Social Security income on top of those distributions we're converting over to Roth IRA, we mess up the whole equation, bud. All right. And lastly, two things. This guy had a spouse, by the way. It's a real life scenario I'm sharing with you. There's two things. One, your spouse is going to outlive you. Okay. So when you die, she gets the larger of the two Social Security checks. Okay. Yours happens to be the largest if you wait until 70 to take it. So if you die, she gets that amount. All right. Now, when you die, she also gets penalized in the worst way possible because there's a hidden penalty in the tax code that so many folks don't know about. And that is that when you die, your bride, your spouse, has 1 year left to file in the joint income tax brackets, at which time she must move over after that 1 year and file as a single filer. So she lost income and she's paying more taxes. Now, the way I can control that is by making sure a lot more of your money is in Roth IRAs so that your wife doesn't have to worry about the increased taxes, which are substantial, and moving from joint filer brackets over to single filer brackets. And folks, if you don't believe me, go look at the numbers. It is significant. All right. It is significant. So that's just a very high level understanding of tax planning and tax mitigation, Spike, and why it's so important. And what's really interesting is if your advisor works at a bank or you go see them in a strip mall somewhere, okay, or a 2-story office building, all right, you know what I'm talking about, okay? Mm-hmm. They are not allowed to give you tax advice. And folks, make no mistake about it, Ryan Wheelis is not a CPA, nor am I an enrolled agent, okay? But Ryan Wheelis has a lot of knowledge between his ears that he can share with you to greatly reduce tax liability. Now, anything I tell you to do or my team tells you to do, you want to run past your CPA. And guess what, folks? We actually get on the phone with your CPA and have conversations with them directly, okay? From our higher net worth clients, by the way, Spike, we actually pay for your taxes to be done, all right? So to that, and we're that committed to it, by the way, okay? So the bottom line is, all right, understand this. If I can save you taxes, reduce your tax liability, I am steps and steps and steps ahead of any other advisor out there in Houston by a mile. So folks, if you want to learn how we can do that for you, how you can save $100, $200, even $300,000 in retirement on taxes, pick up the phone and call us. All right. Or you could easily text the word plan to 21,000. Again, pull out your iPhone, pull out your Android, open up your text app, type in 21,000 in the number, go down to the text box there, type in plan, and hit send. And my team will call you, and as part of your certified financial plan done by our team of certified financial planners, we will go to work and we will show you how we can save you hundreds, potentially hundreds of thousands of dollars in taxes in your golden years.
And to find out right now exactly how much you owe in taxes in those tax-deferred accounts you've been saving into, he's put together a free tax bill calculator. Go to retirenowhouston.com. That's retirenowhouston.com. Then click on the retirement tax bill. You'll put in what you think you have in savings in tax-deferred accounts, what your tax bracket is, and it will calculate for you. It is a free tool. It is no cost to you. Then you can call the phone number. You can text us. Sit down with someone in Ryan's team here from Allied Wealth. For Ryan Wheelis, I'm Spike Spangle for On the Radio here at KTRH. Thank you for listening. If you're on the YouTube channel, you can get in touch with the team as well. Ryan, say goodbye to everybody before we leave today.
Goodbye to everybody before we leave today. See you next week, folks.
Thanks a lot.